Hi, welcome to another Gradient Investment Special Report. Today we're going to be talking about the recent market volatility and the pullback in the S&P 500 and the NASDAQ. So with that, let's get going. So the S&P 500 has now declined as of March 10th, has declined 8.5% from the February highs, and it is now down 4.3% so far this year in 2025. But I always want to keep a broader picture in mind because I think it's important when we're talking about longer term financial plans. But even if we just go back 14 and a half months to the start of 2024, the S&P 500 is still up 19.5%. Likewise, the NASDAQ down 12.3%, so that is officially in correction territory since the February highs. But broader picture, 21.2% since January 1st of 2024. So why are we experiencing the kind of market volatility, and why are we seeing the markets pull back like we are today? Well, I believe a lot in part has to do with the tariffs and the uncertainty around our economic growth that could be happening. So if we think about the tariffs, tariff policies continue to change, right? There's a lot of products that are being placed on extension for another 30 days after it was already put on place for 30 days prior to this. And there's also products that don't have extensions, right? So there's a lot of uncertainty. And what extent is this going to impact our economy, corporations, and consumers? Because the market really likes certainty. And if there's uncertainty around consumers specifically, how much can they spend? How much of the wallet share do certain companies have? The discretionary spend that some of these consumers may have, because our economy is 70% consumer spending. So if there is an impact to consumers, it's going to have an impact on our economy, and it's certainly going to have an impact on corporations. So there's a lot of uncertainty that's revolving around tariff policies right now. And so we're starting to see economic growth expectations be revised lower. Large in part is due to potentially higher prices that will impact consumers' ability to spend because of the tariffs that are being put in place. Additionally, if we are seeing prices increase, it means that the Federal Reserve has to keep an eye on inflation, which means that they have to have rates higher for longer. And if you're thinking about taking out any loans, if you're a business looking to continue to build, it's hard when interest rates are so high. So recent economic data points on top of that, retail sales, non-farm payrolls, they did come in under expectations. So that is also a part of the consumer spending right now and future consumer spending with the non-farm payrolls. But a few data points, it's not a trend, but it's something that we are watching closely. And then as far as corrections go, like we said, 8.5% so far in 2025 from the recent highs. But corrections are a normal course of markets to reset expectations. And we can see that the gray bars here are corrections that happen in that given year. The maroon bars, or the darker bars, are where the market finishes at the end of the year. And so you can see that last year we had an 8% correction, 2023 we had a 10% correction. Even in 2020, we want to think back to COVID, 34% correction, the market still finished up 16%, right? So these are normal courses of the market, and they tend to happen every year to varying degrees, but on average, it's about a 10% correction for a normal market year. But looking at the current fundamentals, GDP growth for the US for Q4 came in at 2.3%, which is in line with longer term averages. Unemployment remains well below average, 4.1% versus a longer term average of 5.8%, or a longer term median of 5.2%. Inflation 2.9, which is significantly down from its peak. Now the Federal Reserve's target is 2%, but that last little bit does take some time to get down to. So I would say that's still a green rather than a yellow, because we are well below that 9% that we had in 2022, and the Federal Reserve has done a great job of getting us down from that peak. 2025 S&P 500 earnings growth estimates are for 11.5%, which is well above average. Now they have come down from 15%, which is where they were at the beginning of the year, but we have long said that that is a too high of expectation, and to moderate that a little bit. So this is probably getting closer to where we believe is fair value for EPS growth for the S&P 500 for this year. Now, where the caveat comes into place is the S&P 500's valuation, which is trading at 20.8 times above the 5-year and 10-year averages, but it's well off of the 22.3 times that we had not just a couple of weeks ago. So I would say fundamentals still look good for our economy and the market. But what do we do from here? Tariff uncertainties, it's a moving target, and it's going to continue to be one, right? We don't have all of the answers. So focus on our long-term plan rather than trading these headlines. We don't want to go to cash. We don't want to time the market. We want to have time in the market. So focusing on our long-term financial plan. And our theme for this year has been bring an umbrella. We always want to reassess our risk. Do we have fixed income assets? Have we rebalanced? Do we have buffered strategies? I think an important point here is if you've been invested in a 60-40 at the start of 2023, that has now become a 69% equities, 31% fixed income portfolio, right? When your start was 60-40. So rebalancing and reassessing our risk, bringing that umbrella does not mean that we're going to have a 2008 type of situation. But the way I always think about it is it may rain. And so you always want to have that umbrella. It may be sunny outside, but you still bring that umbrella just in case. So with that, thank you. And we'll see you next time for the next Gradient Investments special report.